Well, I promise not to read from the book. Generally speaking, it's better to talk about the book and frame the arguments and then put them into a context. I may quote 4 or 5 numbers, which I think are very much to the point, but I guess I don't think of that as reading from the book. Let me start out by saying that the background to this book is not terribly unusual, but a little bit so. I started dealing with these issues as part of a 3-part framework in a book I brought out back in 2006 entitled American Theocracy. And its subtitle was The Perils and Politics of Radical Religion, Oil, and Borrowed Money. Now, the radical religion came to the fore in 2006, very much that same year, and the Republicans took a bad hit in Pennsylvania and Ohio, essentially running under the banner of the religious right in 2 statewide races. I'm inclined to think, barring some very unusual circumstance, that the real threat that was posed by the religious right in the context of George W. Bush and his own commitment to some of the biblical prophecies and interpretations probably passes with him. I can think of ways in which it might be brought back to life if we had another 9/11 type of episode, but I really doubt it. So what I decided to do in August, when the credit crisis materialized and everybody went through a very interesting month of wondering what was happening to the economy, was to go back to the economic side of what I had looked at, and that was on the assumption, based on what happened in August, that the whole thing was going critical, as they would say in nuclear circumstances, and that we were really moving into a significant crisis. Now, at this point in time, as some of you will know and will have followed, you have people like former Fed Chairman Paul Volcker talking about what's going on now as the mother of all crises. As a former president of the World Bank just became about the 3rd or 4th well-known figure to suggest that the total damage of this upheaval was probably going to be more than $1 trillion. You have Professor Robert Shiller at Yale, who's been the principal forecaster of a big decline in real estate, continuing to stick in what seems to be an only slightly hedged projection that we're going to have the biggest downturn in home prices since the 1930s. So my view of this is only the 2nd or 3rd inning. I don't think we're even remotely halfway through this. Now, just by way of an odd calculation, I was thinking this as I was going over and figuring what I might add to my speech outline. Back in August, when the politicians were getting concerned, they tended to predict that the damage of this episode, by the time all the dust had settled, would be somewhere between $100 and $200 billion. A friend of mine who is an economist wrote something in the Financial Times about 2 months later, and I quoted him, and he said, thought the damage would be at least $250 billion. Then, bit by bit, as the new year rolled around, you had a couple of brave souls talking about damage in the $500 to $600 billion range. Now, most recently, you've seen the numbers ratchet up to 800, 945 billion, a trillion, etc. Now, my guess is by the time the whole thing is over, the damage is far more likely to be something in the neighborhood of $5 to $10 trillion. Now, trillion isn't terribly meaningful as a concept because we can't imagine what it is. However, the U.S. gross domestic product is about 12 or 13 billion, and it's conceivable that the damage out of all of this could run almost that high. Now, before I get into the details, let me explain what I'm thinking about. The bare bones damage from debts that can't be repaid, collapsing values on certain financial instruments, and so forth. I'll go with the $1 trillion on that and stake the larger case on some other aspects. If in fact the value of housing was to go down between 10 and 15% nationally from its peak, the loss in net wealth to the United States population would be about $3 trillion. So that takes it up to 4. Now, one of the things that we've seen in recent years, ever since the invasion of Iraq and the very unsuccessful occupation and attempt to get the oil fields in order, is that the price of oil has basically gone up by 500% since the invasion of Iraq. Now, one of the reasons for that is the loss of confidence on the part of a lot of people in OPEC, a lot of oil producers, in both the United States and its Middle Eastern policy and the dollar. Now, the decline in the value of the dollar against the euro since, 2001, 2002 has been almost 50%. But you've had about a 15% decline since last year. So if you take 15% off the value of the dollar in terms of everything that's denominated in dollars, a lot of money there too. And if you take the indirect tariff in the price of oil and how that's risen as the dollar declines and the burden on the U.S. economy and the fact that we have to spend between $400 and $500 billion a year now on oil imports, you start, again, you just put more zeros into the equation. So my guess is by the time all the dust is settled, and if I had to pick a year, 2010, something like that, I think we're going to be looking at something where the tab, the burden that it's imposed, the cost will be enormous, just enormous. And the title of the book, Bad Money, is, well, the dollar is sort of becoming bad money if you're a retiree in Europe. You don't think that the dollar is living up to what you thought it would a long time ago. It's weak money. I suppose you could say it's bad money. I use the term more in the sense of bad money like bad dog, bad Wall Street. Bad people who should have been doing something more efficiently and more intelligently and with a greater sense of responsibility than they were in fact doing it. And that, I think, is the fundamental problem. Now, let me go on to the nitty-gritty here, having sort of framed a larger picture of the money that could ultimately be involved. Now, granted, that's a pretty far-reaching definition. Now, in some ways, I think a good analogy to describe what's going on is to think of the U.S. economy as having fallen into something that's turned out to be a shark tank. Now, the shark tank is important because if you go back and you look at the 20th century, the sorts of recessions that we had at 3, 4, 6-year intervals, distances like that, they mostly came out of the infrastructure of the manufacturing economy, out of excessive inventories, out of the need to lay people off because there wasn't the amount of demand, the sort of thing you would expect if you had an economy, which would have been true in the 50s and 60s. It was at least 30% manufacturing. Now, by the 1970s, it was starting to change.